Hello and welcome to BQ Prime. You're joining us on another episode of Bankable, a show where we discuss how the operating environment is looking to the bankers who are in the system, what is it that they're looking at as opportunities, and what are some of the challenges that they're trying to overcome to achieve their goals. And today, to discuss this further, we have with us Mr. Ittira Davis, the MD and CEO of Ujjivan Small Finance Bank. Mr. Davis, thank you so much for joining us on this conversation. I just wanted to start this conversation with the idea of a small finance bank. Right? This was brought in as a diversified sort of style of banking, a differentiated style of banking along with the payments bank system. Now, when we look at the definition of what a small finance bank is, it's targeted specifically towards getting to the bottom of the pyramid or at least mid-markets where your universal banks probably don't reach as well. To your mind, how has this evolved over the years for Ujjivan itself as well as the whole system? How has the small finance bank ecosystem evolved?
It's good to be here with you at BQ, Vishwanath. It's been a while, so nice. And a very good question, because I think what has happened is the small finance banks were brought on for a differentiated license because they felt, as you rightly said, the bottom of the pyramid, the people who are not included in the financial system were not being given a chance. So this was a way that the RBI felt we could be able to address them directly. So I think in terms of the objectives which it was set up for, and most of us have been in operation for now 6 or 7 years, having started in 2016, 2017. And all of us have been around. What is important, and I just mentioned this as a side, that we had 2 devastating years of COVID.
Yeah.
And all 10 of us who were given licenses in 2015, towards the end of 2015, and started operations in 16, 17, have come through COVID. So as a business model, it has done very well in terms of the business structure itself. We are all around still doing what we have set out to do. And I think if you look at what we have done, I think we have punched above our weight. We have done fairly well on that and have offered services across the board. And the 25% that we were required to open branches in the rural unbanked areas, that is also done very well. And overall, I think, it's a good proposition. And having said that, it's not that we have just kept it to the basics. Many of us have gone into digital, and I think that digital offering to the bottom of the pyramid is definitely going to make a difference. I think that is quite a significant part.
Okay, let me break these up into different parts and different questions. First, let me tackle COVID. Now, this was 2 years of an event that nobody could have predicted. Nobody was actually ready for a pandemic where everything sort of shut down. How has a small finance bank ecosystem, as well as Ujjivan, how have you managed to sail through this? Because a lot of your business depends on reaching out to people, talking to people, right? Because a lot of you were MFIs and you had a direct connect with your borrowers. How did you manage to sort of sail through this period where you just could not meet your borrower?
Yeah, that was a difficult period. We had our branches, because we are essential services. The branches were open, but of course in certain areas which were contained zones, we had to close. But otherwise, we kept the branches open. Wherever customers came to us, we addressed their issues. But we couldn't have the usual center meetings in the field, which is the core to microfinance and most of the small finance banks. Microfinance is a large part of their business, and for us it is. So to have that monthly connect with the customer, that was lost. Not across the board, but by and large, because the customers came to us, we addressed them and took care of their needs. Some of our field officers were trying to speak to the customers, and that is really where the virtual connect with the customer started.
Yeah.
Through WhatsApp, through the regular calls, etc. But then many of them were affected. Some of them had to leave and move on because they couldn't make ends meet, and the economic situation was such that they had to find or go back to their homes or wherever else if they were moving around and working in other places. So all of that, when you add it all up, it's a significant impact which it had. So those 2 years, 2021, were very difficult years for the whole industry, and more so for those who were catering to the bottom of the pyramid. So I think that has to be understood in the context of how things turned out. And then you have our regulatory environment, which requires us to recognize loans as they turn bad.
Yeah.
So that recognition took place. But, fortunately, COVID came to an end, or at least it tapered away. Indian economy did very well, and I think that is really the crux of the turnaround. So I think, when you look back and see how did it play out, the fact that the economy was able to bounce back helped us. So just like the bottom of the pyramid got affected when COVID came, they were the first to bounce back, because the people in other industries were still wondering, should we invest? Should we put money into those sort of projects which requires capital investment? And they said, no, we're not sure. So they postponed those investments, which is actually some of the effects of which are playing out today in the inflationary front, because demand has picked up much faster than supply. Supply is trying to catch up. But coming back to the bottom of the pyramid, the turnaround helped them, and that is what you're seeing in our numbers. 21, 22 was a difficult year for us, but 22, 23 was spectacular. The recovery has been fantastic, and I think that talks for itself.
Isn't it also a fact that a lot of your borrowers really don't have another option? I mean, their livelihood depends on the business that they do, right? And postponing or maybe waiting and watching how the situation evolves is not really an option for these people. But then, how does a lender manage a business where a large part of your borrowers are dependent on how daily business works, and there's no real sort of margin of safety that they carry with their business? How do you deal with that?
Yeah, this is where I think, for us, the people on the ground make a big difference.
Yeah.
Because what happens is that they understand the market, and we are in different markets, and different things tick in different markets. So, trying to pass, sort of standard policy from the head office in these situations is very difficult, because we are in 25 states, and each state and each part of the state operates differently, and recovery is at different phases, especially in this situation.
Right.
So what happens here is that we get the feedback from the ground, and we have to take decisions based on that. And that feedback is very important. So the feedback we were getting is that there were pockets, initially some pockets, the pockets increased, and then it was a total all-round recovery. So we allowed them to, within the parameters that we have, to reconnect, and we initially started dealing with the existing customers, so who have a track record with us. And if that track record was good, and they came and said, okay, we would like to do something to reactivate, we used to give them the go-ahead, and they used to do it. So all the existing customers got priority because of the situation. Then a little later, we started adding new to bank customers,
right?
And that is how the business built up. And in terms of disbursements, 22, 23, we had 20,000 crores of disbursements, which was by and large the highest that we have ever achieved. And I think that is, talks for itself in terms of the numbers.
So, coming to the post-pandemic period, now Ujjivan as an entity had some leadership, changes. You had to come in back and start leading the bank as its MD and CEO. Are we past all of those sort of periods of slight volatility? Are we over that now?
Yeah, I would say, definitely. I think that situation is behind us. That was partly affected, as I said, by the COVID conditions. Those things are behind us. The management is stable. The board is very stable. And, there is evidence of that confidence. Even the regulator, who had a representative on our board a few months ago, withdrew the representative, because they also feel that the situation has come back to normal and has stabilized. So all in all, I can tell you is that, on that aspect, the stability has returned. And obviously, such things reflect in the numbers. And that is what you're seeing as we go forward.
So one of the pointers during that time that was mentioned was the governance angle as far as managing the bad loan portfolio is concerned. What has changed materially when you're underwriting a loan and then monitoring that loan? What has changed at Ujjivan?
The underwriting of the loan, we learn from circumstances. And we have, of course, the textbook which is there. But the practical aspect of it comes along when there are situations.
Right.
And, the COVID situations taught us a lot about that. And, we have brought that into play in our decision making. And also, we are looking at different industries in different ways, because each of them has their own dynamics and they need to be understood. So that is something that we have brought in. And also, previous to COVID, collection was done by our own staff.
Right.
because the numbers were really fantastic in terms of the NPAs.
Right.
Below 1%, used to be the situation before COVID.
Correct.
You may be thinking that we are dealing with the bottom of the pyramid, but the numbers are fantastic, so talk for itself. So when you look back at the COVID situation, what happened there was that, the numbers, started compounding, and we had to bring in resources from outside. So that is something that we have understood that we may need to do from time to time, completely different. We have learned how to do that, and we have learned to do that very well, because our story about the recoveries is quite, very spectacular or very special in the industry. And that is how we managed an outside resource. At the top, our people are all, our own on-roll employees. The people in the field who may be doing that are off-roll, but they are managed by our own staff.
Understood.
So to guide them, to make sure that they follow the guidelines and all that, we make sure it's handled by our own staff. So a combination of this is very good.
When it comes to small finance banks in general, there is this expectation that you all need to grow at 35-40% because that's the only way it makes sense. Considering that your size is smaller than a lot of other universal banks in the system, 40% is the minimum ask that a lot of analysts point out. Some of your peers are growing at that pace. To your mind, is there such a thing as ideal pace, or is it just whatever fits your business?
Yeah, it depends on the circumstances, because you have had 2 years in COVID when you didn't grow. So growing at 35-40% as a catch-up is quite possible.
Yeah.
So that is a sort of one-off situation. An ideal thing of an ongoing normal environment, what is that each one has to decide. But to me, I think a 30% growth for a small finance bank which is gaining ground in these years is good as the economy grows. Now, if the economy is not growing and you're growing, then obviously there may be certain risks you're taking.
Correct.
So as the economy is doing well, I think growing at that pace is reasonable and is something that you can accept if you have got all your other fundamentals correct, because that is very important. The fundamentals and everything else has to be in good stead.
How closely is the regulator involved in all of this? Is there, because this was the regulator's idea, right? The idea of a small finance bank came from the RBI. It was from an independent report that was constituted by the RBI, and then they gave out the licenses. How has the regulatory environment been for you as a lender? Is it one of fostering growth, or is it, okay, we've given you this opportunity, but you better do a good job, otherwise we are shutting you down? Is that the kind of approach that the RBI is taking?
No, I think the RBI has been very supportive, and at the same time, following the regulations, because whatever is there for the universal banks, by and large, applies to us, except for those areas where we have got special regulations. Those apply over and above the universal bank. To that extent, the regular inspections, the regular reports that we send, the dialogue that we have with the RBI is very similar to what they have with the universal banks. I think to the RBI, this is something which is succeeding, which is doing well. If you look at all the numbers that we have by way of customers that each of as a small finance bank industry we are doing, I think we are punching above our weight. And I think that confirms to the RBI that we are doing what we are set out to do. So I think all in all, it's a supportive environment, but at the same time, we have to follow the rules, like the 25% rural unbanked and things like that.
Yeah.
These are all adhered to, and I think we have a regular dialogue with the RBI as an association and individually, and I think these things are all addressed in those discussions.
The reason I bring this up is because technically your cousins, the payment banks, have not had that much of a success. There's one payment bank that is actually doing reasonably well, and even they are talking about converting it to a small finance bank. So this differentiated banking idea, can a bank exist solely on liabilities? Is that something that's even a reasonable business model?
I mean, I haven't checked it out as a banker, but yeah, looking at what the response is from the other payment banks or from the payment banks, I think that's a little bit of a challenging model. So maybe one or two can work with that model, but as a licensing condition, it's a difficult model to be able to achieve. Unless you tie up and have partnerships and you work with others, because I suppose there are different ways to approach this. But in the normal way in which you do the banking operations, it will be challenging.
I want to dig a little bit deeper about this microfinance business, right? You were originally just a microfinance lender. You sort of developed other businesses alongside it, and now your book is what, 60-40, 70-30?
No, it's 70-30.
70-30, right? And what is your long-term goal there? But how far do you think your microfinance business will need to shrink to accommodate for the rest of the businesses?
Yeah, I mean, our 3-year objective is to make it 60-40, 60
Right.
microfinance and 40 all the other, all secured lending.
Right.
So that we have a 60-40 secured and 40% secured, 60% unsecured. And then it's for the board to decide whether you want to go to 50-50, because 60-40 is much better than 70-30. And having said that, each business, if we know how to manage it and understand the risks, whether it's secured, unsecured, can be managed. Sometimes having been in banking all these years, the secured, part of it is really not that secured when you come to the final analysis of it.
Correct.
So on paper, it looks secure. So I think, if the dynamics of the unsecured business is well understood, if we are able to manage the risks, and if we have to mitigate those risks, I think that is a good model to have. So perhaps 60-40 is good, perhaps 50-50 is needed. I don't know. But we are focusing on getting to 60-40 in 3 years' time.
Okay. What is it that's going to fill that 40? I mean, is it largely, you talked about unsecured, but is that where you want to grow further in the other unsecured businesses? Or do you think that housing is also an important part of it all?
Yeah, for us to be able to get to 60-40, the secured businesses have to grow faster.
Yeah.
And here, housing is doing extremely well. Because last year, we went back to the drawing board and we looked at our housing business. And we have now started putting in place something called asset centers across the country, especially in the urban areas. So we're going to have about 16 or 17 of them during this financial year.
Yeah.
So that allows us to grow the housing book a little faster. Together with that, we are now in the process of relooking at our MSME business. How to relaunch that in a way so that it has a longer term growth perspective. So that we will do in second half, and it will be fully operational next financial year.
Yeah.
When that comes in, MSME will contribute. So right now, housing is contributing about 15%. MSME is slightly less than 10%. And we have now also we have launched on a test basis our vehicle finance and also gold loans. We are a late entrant in gold loans, but we have found that many of our customers, especially in the microfinance area, are looking to gold loans and they're going to other banks for it. So why not, and many of them are very good customers.
Yeah.
So why not try and offer them what they are looking for, and that way they stay with us for a longer period.
When I was speaking with a prominent gold loan lender as part of the show, their approach was that, okay, a lot of banks don't really know how to do this business. They think that just collecting the gold and giving people money is the business, but that's not it. You need to have a service model that fits the customer. You need to have a dedicated staff that knows how to handle a gold loan. How much of an investment is it as a lender when you're starting out on that place?
See, in a way, some of those things you mentioned, like knowing the customer, managing the customer, is already there when we are talking about existing customers. When it comes to new customers, we have to learn to see who they are and understand them. But the CRO or customer relationship officer, which we have, is focused on understanding specific needs. It's not like a commodity operation. Yeah. So each customer, although is unique, we try to understand and build a relationship. But that's the longer term objective. So to that extent, that is a given investment in any business that we do.
Yeah.
And to that extent, whether we go into gold loans or not, we are doing it. Now, some of the systems that we have, the valuation, the storage, and all of those sort of things requires something very unique for gold loans. Now, if you're going to get into it and going to stay into that business for a longer period, it makes a lot of sense to invest into that. Initially, yes, it's a cost, but in the long run, it will help the business to grow and pay for itself.
Okay. I want to touch a little bit about the liability side of the story now. So, as a lender, your business is a high cost model because you naturally have to pay a little more to the depositors than what your universal peers would be paying. How has the current system affected the cost structures for Ujjivan? Because we are in a rising interest rate, well, peak interest rate scenario at this point in time. But you still need to give at least 100, 150 basis points more than the public and private sector banks out there. How has that changed the cost structure for you?
No, I think, when we started as well, the fact that we were coming in as a new breed of banks, and we had this small thing under our name, which we have to keep as per the regulation is concerned, put us, slightly on the back foot. So as small finance banks, we were always paying slightly higher rates than the universal banks and the private banks and the nationalized banks who are here. So that has been the situation from the very beginning. Now, fast forward to this financial year or the last financial year when interest rates started rising. So that was for many of us a new situation in the current context of the small finance banks. So, some of us took the decisions that this interest rate scenario was here to stay for a while. It's not just a 3-6 month situation because of the post-COVID inflationary trends. So we pitched ourselves according to that. So that was the situation from about, I would say, last September till about the time, the announcement was made about the HDFC merger. And also the larger banks started finding that deposit mobilization was getting difficult because RBI was taking liquidity out of the system. So then the differential started narrowing, and I think now we have a situation where the small finance banks and the private banks, especially the smaller ones, have to be, on the lookout for getting those deposits. Now, for us, deposits and interest rate per se are not the only things. We pride ourselves about our service. And of course, every bank will tell you that service is the differentiating.
That was going to be my next point.
And it is. It has to be. Because otherwise, what is it? I mean, you have a choice of 10 banks.
Exactly.
And you can go to any one of them. So at the end of the day, the service. So, small finance banks started this sort of thing of coming to the doorstep and doing your banking. You could open the account. You could call the banker to your doorstep. As far as private banks are concerned, or many of the others, this is only provided, if at all, to high net worth customers. Now, for us, anybody can, a senior citizen who's not unable to come, even anybody for that matter, can request that you come to the doorstep and do that. And we were doing that in a way when we had these center meetings. Because we were meeting the customer, not at the branch, at a place close to them. So a kilometer here or there going to their doorstep was doable. So that is the type of service we are delivering in terms of opening the accounts. Now, as I told you, we are on the verge of this digital turnover or changeover. One of our competitors is offering a 24-hour digital support. We are also going to be doing that starting October, and then by next financial year, it will be across the board for all customers. So that, I think, is a quantum leap where you are combining, at the bottom of the pyramid, the type of service. And on the liability side, mind you, we give this service across the board. Our customer base is not just the same as the asset base. Every customer, even a high net worth customer, can be our customer. Because there's always something that is unserved or underserved.
Correct.
So some of them may prefer our higher interest rates. Some of them may be looking for better service. All of those. So I think, we are able to provide that as a group, and some of us may be better than the others. But I think that is a real differentiator. And going forward, that will eventually give the direction in which whether interest rates will narrow or stay apart or grow further apart. Because there is a scramble for deposits right now. And I think in the next 3 to 6 months is going to be the definite period when this is going to be a very tough situation. And we are closely watching that as it evolves.
So, among the private sector space, at least, a lot of hiring happens on the customer service, H&I customer service end, right? Now, as you said, any customer is your customer, at least on the liabilities front. How do you offer that kind of a very personalized, customized service? Do you also make those high-profile hirings? Because for a bank of your size, I don't know how much sense it makes business-wise to hire that kind of staff.
No, we have a combination because first and foremost, any institution, the people there have to understand the ethos and the culture of the institution. Because, just hiring and sending them into the field is not going to get the result. So you have to be able to communicate what you stand for and how the overall thing is. So we have a combination of people from outside and from within Ujjivan who are now addressing, because we have relationship managers for our high net worth customers, because their needs are slightly different, and we have relationship CROs for our microfinance customers. So customers' requirements are looked at in a way that these type of customers need these services. Others may not require all of them, so we need to tweak some of these. So that is how our product managers in the liabilities team, they are looking at that, trying to understand what these customers need, and then trying to make sure that we address those broad business groups that we have, or customer groups that we have for these businesses. So that is the way we do it. Even we hire from outside. We hire from, many of them hire from us. We hire from them, but all of them have gone through training and induction program, where certain of our value systems, our culture is all embedded and imbibed by them, and then they go into the field. So it's a combination of those effects. So I think, we will take from the private banks, nationalized banks. They will take from us. This is an industry which, in this business, is going to go back and forth. Okay. But those who join Ujjivan have to know the Ujjivan culture as well before they go out into the field and talk to customers.
Talking about the reverse merger now, so that's something that was announced last year. We're still in the process of merging Ujjivan Financial Services within the bank. Practically speaking, I understand that tax benefits and the holding company discount, working out for shareholders there. Practically, what does it change for the bank? Does it change anything at all?
No, it doesn't change anything. The only thing is that now, instead of one shareholder holding about 73-74% of the shares, which is the holding company,
correct,
the shareholders of the holding company become
more diversified.
More diversified, yeah. So that is the only main change. As far as business is concerned and running of the business, there's no change, because the holding company is not into any day-to-day operations.
Yeah.
It only has the shares of the bank as its main holding, and some investments which they have made. But otherwise, there's no, it's not that they are doing something which we need to absorb. So it's just, it makes a lot of sense in terms of some synergies of bringing capital together and of reducing some costs. But other than that, there is nothing, no other practical effect of that.
Is there, okay, so I'm sorry, I'm going back to the original point of the volatility period for Ujjivan. But one point that was thrown at that point in time was this fight between an old way of doing business and a new way of doing business. Is that real, or is that just something that people cooked up in their own minds?
See, I think, when you go through a tough situation, and in this case, the tough situation was due to COVID.
Yeah.
Literally around the same time when the new management came, COVID started.
Yeah.
Although, I think it took 2 or 3 months to be officially notified as COVID.
Yeah.
But, in those circumstances, so then we had the impact of that. So people can say they can put different shades to, trying to say what happened. But I would just say that circumstances made it very difficult. And, things played out, and there was a change again, and, it's history behind us.
Yeah.
So I think been a good turnaround.
Fair
and, we are where we are today.
Last question from my side is this point about graduating to a universal bank. Now, that's something that you've expressed previously, that you want to move into the universal bank category. But my question goes back to the SFB model. You said we are punching above our weight, right? But is the best that a SFB can hope for is the right to be converted into a universal bank, or does the SFB model on its own have legs to stand on?
No, absolutely. The SFB model has its own legs. We have seen in the last 7 years how SFBs have all done.
Yeah.
And I think, each one.
I'm talking about a long-term view.
Yeah, in a long term, continuing to be an SFB, yes, it can happen that way. But obviously, when you keep growing and you want to grow into, in our case, I can talk about Ujjivan's model. What we are looking at in our transition into a universal bank is to continue our customer base, our focus will continue to be the mass market. It's not that we're going to suddenly change our focus and everything else. But the flexibility, or the greater flexibility which is available with a universal bank, will allow us to do that in a much better way. And I think that is the important factor, because For example, I mean, now I can tell you that this interest rate hike, RBI has raised the repo rate several times, I think 250 basis points.
Yeah.
In our case, given that we are dealing with a customer base which is vulnerable, we had to manage that increase. We have done only 250 basis points increases. So that's 100 basis points against 250. So, that is the situation. But if we were a universal bank with, lower capital requirements, lower PSL requirements, perhaps we would have greater flexibility and can continue that for a longer period. So these are the things that play out when you look at a longer period and even addressing the same customer base. Of course, we'll be allowed to do a lot more because the 50 lakh loan limitation, 25 lakh loan limitation on 50% of the portfolio goes away. So you'll be able to deal with the
larger
bigger
ticket
customers.
sizes.
But that is going to play out as a normal course of business. Not that suddenly we'll jump into project finance or we will go into these sort of large
transaction finance,
large corporate banking transactions.
Yeah.
Because that's not really our thing. We may do a few which make sense within the broader, which we are also doing. We lend to other FIGs and things like that who are doing similar business and other types of business, which is a small part of our portfolio. So that gives us a lot more flexibility. So all I'm saying is that by itself, the SFB model has been seen to be a model which is successful. But the transition will help us to grow and will be able to play out this role even better.
Apologies, I said last question, but this is my last question. Also, the question that I wanted to ask you is the business of lending to the bottom of the pyramid, right? Or doing business in the bottom of the pyramid. This is a question I ask a lot of people who are in this space. But is the business best served as a for-profit, a business-oriented point of view? Or do we still need to keep in mind that there's a moral sort of side to this business, that you have to lend to this group because this group is devoid of credit? They end up having to go to landlords the money lenders who will end up charging them way too much interest, and probably that's not the best for them. What is the best way to approach this? Is this a moral business or is this a business that's meant to make money?
I'll answer this question by saying you combine the two. It has to be moral, it can make business. See, today, India, the number of people who has benefited from this microbanking finance on a broad basis is the largest in the world. And that, could not have happened if it was just a, sort of NGO type of situation.
Right.
You needed the business part of it to go.
Right.
But overdoing the business as against the moral part is also not correct. So that balance is very important. And if you can strike that balance, then you got it good. But I think that is the thing which RBI and the regulator needs to make sure that
balance.
The balance is well there. Because once you can establish the balance, then we can keep growing. And that bottom of the pyramid is growing. It's not earlier we had the pyramid. Now it's becoming more like a diamond. People are moving up.
Correct.
And that is what we are seeing, because the customer ability and mobility in the economic frame keeps moving, and that is what we are really trying to encourage.
All right, Mr. Davis, thank you so much for joining us on this conversation. It was a pleasure talking to you.
Thank you. It's a pleasure as well.
Yeah.
Thank you.
Yeah.